I'd like us all to give an absolute massive round of applause to Mr. Ranjan Bhattacharya.
Well done. Thanks very much, guys. Okay, so what are we going to talk about? I'm going to leave you with 7 steps to succeed over the next 5 years. That's what I'm going to leave you with on my final slide. But first, I'm going to kind of set the scene for all of that. Now, I want to ask you guys a question. Who was actually investing in property in the early 1980s? Hands up. Show of hands. 1 or 2 folks, but not many. Not many folks were investing in property in the 1980s. It's very, very strange. Because sometimes I wonder, I wasn't investing in the early 1980s, by the way, I was in shorts. I mean, I just read about it in history, what happened in the early 1980s investing, I should say. But anyway, sometimes I wonder what's happening today. What decade are we in? I mean, we're in a time where Top Gun is the top movie. We're in a time where Kate Bush is in the charts, top of the charts again. We're in a time where even Arthur Scargill is on a goddamn picket line in 2022. Sometimes feels as though we're on the brink of war with Russia. You know, what decade are we actually in? And Duran Duran. Duran Duran are playing Hyde Park next week. Can you believe it? What decade are we in? It's back to the 1980s in more ways than one. An interesting thing happened with inflation. We all know inflation is sky high at the moment. But the interesting thing is that we are pretty much the same levels as it was in 1982. So no one has seen the inflation rates that we're having now since 1982. The other thing is the way they calculated inflation back then was different to the way they do it now, because they fiddle it, don't they? You know, we've talked about this in previous meets where they change the basket of goods that they use to calculate the inflation rate. If you actually compare like-for-like inflation between now and back then, we're probably at 12 or 13% rather than 9%. The other interesting thing about 1982, which we need to have a real think about here, is when we were at 1982, it was on a downward trend after that. You know, the late, great Maggie Thatcher did some good things to actually bring down inflation after coming into power in 1979. If you look where we are now, it's not at the peak. That graph ain't going to suddenly come down. It's got a little bit way to go. The Bank of England is also saying it's going up. So it's going to go further up than this. It's not in 1982 when it was on its way down. The other thing to bear in mind is this thing about interest rates. Interest rates is not the cure to solving this problem. I've got this little graph here which shows the relationship between interest rates and inflation. Now, when inflation is caused because of naughtiness by the government, and when I mean naughtiness by the government, I mean overspending, spending too much money. When it's caused by the government, then normally to bring things into line again, you have to raise interest rates. And you have to raise interest rates to beyond the level of inflation to bring it down. But this time round, current inflation spike has not been caused by the government's naughtiness. It's been caused by the fact that energy prices have gone up, which has fed into absolutely everything. The last time this happened was way back in 1972. There was the oil price crisis, and energy prices rose dramatically in a massive spike. And because that was an international thing, rather than caused by an individual government thing, that's why back in 1972, interest rates weren't the solution to solve that problem. Raising interest rates above inflation only works when the inflation has been caused by the government of that nation. So here we have a situation, very, very similar. Interest rates are going up. It hasn't necessarily been caused by the government of the day. They have contributed to a little bit to it by money printing, but so has the other countries. So they've all kind of done it together relative to each other. The real cause of this spike right now is the energy price rise spike, which has basically meant that everything has risen in price. So what does all that mean? Interest rates aren't the answer. So we've got this massive issue, and not this issue, this is an opportunity. And I'm not sure how many people see this as the opportunity it is. We've never had this differential. This is the differential. That's inflation in April 2022, and that is interest rate. So you may be thinking interest rates are high, and they're going up, and you might be worried about it. But in real terms, real inflation is actually cheaper than it's ever been. Because what matters is this differential here. We have never had it so good. Because interest rate, the real interest rate, is basically the difference between inflation and the actual interest rate. And we've never had that margin before. It's massive. So what that means is, if you went out and borrowed 100 grand, it's actually quite cheap, because the value of that 100 grand is going to be frozen in time. We're not at the peak with inflation yet. Inflation has got a little bit more way to go. And the other problem is that the elephant in the room is, I don't think anyone actually knows how to fix the inflation problem, because it's not caused by an individual government. It's this energy spike. So this may be with us for a few years. So this means that double-digit real inflation will be with us for a few years. And if interest rates aren't the method of solving that problem, and we have this differential between interest rate and inflation for a few years, that is a phenomenal opportunity. Because 100 grand borrowed today will be, the value of that 100 grand of debt will be worth less as the years go by. As each year goes by, the value of that debt goes down. But if you're focusing on using that debt to finance income-producing assets, and you fix the debt at the same rate of interest for 5 years, and you're generating positive cash flow, then you are quids in. Now, if you think about it, I'm going to talk about this a little later. Inflation is a massive killer. Most of us will not have invested in this kind of environment. Inflation is a secret tax. It's a tax that no one votes for. You can't really blame a government for it. But if you've got money in the bank, you're being robbed of the value of that money that you have in the bank. And there's very, very little you can do about it to even preserve that value or even come out ahead. One of the great things you can do is property, simply because of the value of leverage. Because to buy a £100,000 property, you don't need £100,000 of cash, you borrow 3/4. And the value of that debt will go down. For each year, we have this double-digit kind of inflation. So let's just pull all this together and kind of just lay out exactly what to expect out of the next few years and the climate that we're now in. Money is cheap. I really don't, I'll stick my neck out, but I don't think interest rates are going to go up more than 2.5%, perhaps 3%. But the differential between the interest rate and the inflation is going to be massive. That's where the opportunity is. That's the thing that we want to watch. In previous times, people often talk about the 1990s. Inflation went to high single digits, and the government put up interest rates to higher than inflation to bring it down. Because it was a UK problem as opposed to an external problem, and that worked. Putting up interest rates will not be the answer to this problem. It'll be like the early 1970s, because it's externally caused. That gives us a massive opportunity. I've talked about this unofficial tax. We're not at the peak. The Bank of England have always been very conservative in their predictions of interest rates, haven't they? You know, they say something for a few months' time. When we get to a few months' time, we find out they're wrong. And they're wrong usually by underestimating what it's going to be. If you do nothing, then it's an unofficial tax. Whatever you're earning is rarely going to keep up with inflation, because the economy can't really sustain it. If you've got cash in the bank, you will lose that value of that cash in the bank unless you do something. We'll get back to the video in just a moment. What is the most exciting opportunity in property right now? And that is repurposing defunct commercial buildings to residential use. Now, most people don't really know where to start, what to look for, and how to exploit these opportunities. And that's why I've prepared 90 minutes of free training for you to get you started on this wonderful journey. You can register for this free training at property-workshop.com. Join me on that free training, and I'll leave you to enjoy the rest of the video. There is a recession coming. Why is there a recession coming? People are talking, some people saying, oh, there's a recession coming. Some people say we're bouncing along the border of a recession. There's a big recession coming. And here is why. And it's very, very logical when you think about it in these terms. The energy cost spike has put up everything. Food, traveling, the whole works. And that's fed into everything that you want to do. And what that means is your disposable income is less. The amount you have to spend on discretionary spend has decreased because the amount you have to spend on the stuff that you need to do to keep your life going has increased. The necessaries have gone up. You know, I've just seen this anecdotally. I mean, it's a couple of months ago, it wasn't so easy to get a table at a restaurant on a Friday or a Saturday night. Recently, I've found that you can just waltz in on a Friday, Saturday night and pretty much get a table. There's something happening. So when you find that there's such a squeeze on what people can spend, because they're spending more on necessities than discretionary, all those businesses that sell discretionary goods and services suffer. And the ones with failed business models, the ones that are a little bit more of a dinosaur, the ones that are over-leveraged, they will all start to teeter. And businesses basically operate from commercial properties. So you always find that when there's a recession, commercial property is hit because businesses occupy them, they fail, they become defunct, they become vacant. But this time round, this is the first recession where we have actually had permitted development rights in spades that allow you to repurpose these defunct buildings to alternative uses. Now, we talk a lot about repurposing defunct commercial buildings to other residential uses, but the government have made it far easier to repurpose commercial buildings to other commercial uses, because that can be very, very good as well. We have never had these sort of rights in a recession before, to come in with this oversupply of commercial property. The other thing that's happening, and I'd like to stick my neck out on this one, is on residential prices. Now, what we are seeing, and you've got to be very careful when you listen to mainstream media, when they talk about the word fall. What is actually falling? A lot of the talk is about the rate of growth. The rate of growth that's been occurring in residential prices over the last few years is obviously not sustainable. That is falling and will fall to near zero. But in terms of actual price falls, I think that is unlikely. And there are several reasons for that. Firstly, we know we've got massive undersupply. We need 300,000 homes a year. We're only building 200,000. But the other interesting thing the Bank of England have done, and I put a YouTube video out in January about this, the Bank of England put a consultation paper on changing the mortgage affordability criteria. So after the credit crunch in 2008, the Bank of England increased the stress testing. So they basically lessened the amount you can borrow for residential and buy-to-let mortgages. They've loosened those criteria now. So yes, interest rates are edging up a little bit, but the bank lending criteria have also loosened. And provided, if you're buying investment property where you can cash flow it so that it's more than enough to service the debt, and you fix your debt for 5 years, then that shouldn't be anything to worry about. Of course, the other interesting perspective is if you're doing property, you have to look at exit. And what I always do in recessions, I kind of switch. I don't really like to exit property deals by selling on, because selling on can be a little bit uncertain in recessionary times. The thing to focus on is exit through rental. Now, at the moment, rental prices are increasing, partly because of the shortage of supply for demand, partly also because of inflation, because inflation kicks in to rents as well. So what that means is it's easier to cash flow properties on exit, and if you can get the rental income, you can get the debt when you refinance once you've done your development or conversion. What I'm going to outline is what we are actually advocating to our students, what we are doing personally right now as the strategy over the next 5 years. It's to pick up, it's to get equipped really, to find and source and negotiate and structure deals that involve defunct commercial properties. because those are going to increasingly come onto the market in greater numbers. So the skills you need to acquire very quickly is how to find these deals, how to negotiate and structure the purchase of these deals so that you don't have to put in that much money into the deal in the first place. There are lots of hidden benefits with commercial properties, which people may not know about. There are things like dilapidation claims, there are capital allowances, there are VAT issues. There are all sorts of things that can contribute to a lower ticket price of actually buying and acquiring a commercial property in the first place. So it's about learning about all of that sort of stuff. The permitted development rights have gone on steroids, both in terms of repurposing commercial to commercial and rights to repurpose commercial buildings to residential use, either fully or partially. Now, it is about getting an encyclopedic knowledge of those rights, because you need to be able to go into a building. I mean, we're doing Property Elevator. Season 4 is on, I think the next season, episode 2 is on telly tomorrow. In this season, most of the juiciest deals are commercial to residential conversion deals. Why? Because there's such a differential between vacant commercial stock and end residential values that there's a profit in there. And if you're looking for joint venture funding and getting an angel investor on board, those are the juiciest deals with the most in it to attract investor and JV finance. So what you need to be able to do is to actually spot a site. And the thing with the permitted developments right now is just because you can convert or repurpose a building, it doesn't necessarily mean you should. You can do quite a lot with many, many types of buildings, but some buildings simply aren't worthwhile, and some buildings are actually worth it in spades. It's about differentiating between the two quickly so that you make the right decision. And then it's about converting a building to an alternative use. Skills to acquire is in managing the conversion works and orchestrating all of that so that everything happens smoothly, and also financing those conversion works as well, so you don't have to put that much money into the proposition to start with. And then the exit that I'm advocating is once you're done, you're doing deals where you can refinance, pull out pretty much all of your money from refinancing it at the end, and then letting it out for at least 4 or 5 years. And in that time, you'll get capital appreciation, you'll get rental growth, and you'll start to build that portfolio of appreciating assets. So my 7-step plan is this. Do deals with 30% margin. So you're buying something, and you add in all your purchasing costs and your development costs and everything like that, and then you look at the end values. And the difference between your total costs and your end values is 30%. When you watch Property Elevator, if you look at all the deals that were funded in season 4, they all had a margin of 30% plus, because that is something which people feel comfortable with, and there's enough in the deal to bring on private investor type of finance. So that should be a yardstick that you build in. I would only look at developments, or we're only looking at developments, where the total 30% margin uplift is achievable from permitted development rights. Planning permission, quite frankly, is a pain in the behind. You may get it, you may not get it, you might get it in 8 weeks, it might take 8 years or never. Permitted development is a set of rules that is the same across the country, and if you know the rules, if you know that tick list of criteria, they can't stop you. The local authorities cannot stop you as long as you've got all your ducks in a row, and that is the most important thing. So I tend to stick to deals, 30% margin, and where all the works are achievable through the development uplift is achievable through permitted development alone. And I'm looking at projects where we are repurposing for rental. So sometimes it's converting a commercial building in its entirety to residential use. Sometimes you keep some commercial space repurposing it. I mean, at the moment, we're repurposing an office building into a private GP surgery, because that makes better use for that site. That's a better uplift for that site than converting to residential. So different sites will have different characteristics and different end game opportunities. But it's all about repurposing for rental, whether it's commercial or residential use. The exit I mentioned is refinancing. When you've converted a building, you've got it tenanted, if you've got 30% margin in the deal, then you can basically refinance that entire development on a 70% loan-to-value loan. When you get a loan at 70% loan-to-value, you need 30% equity. This is why I'm so keen on doing deals with 30% plus margin. Because what you're doing is your profit margin on the deal, you give to the bank as your equity. Well, you don't give it to the bank, it's yours, but you use as your equity that you need to own the asset. Does that make sense? So that means when you have got that property developed and fully let out, you can pull out all or close to all of your money. And then you end up with little money left in the deal. And as long as you've fixed your debt for 5 years and you're making positive cash flow from day one, you've pretty much got an infinite return on the cash you've got tied up in the deal. You hold that for 5 years, you have double-digit inflation for the next 3 of them, the value of the debt that you've got will be reduced in value, your overall cash flow from rentals will be increasing in time, and in time, the capital value of the asset tends to catch up with inflation as well. It doesn't catch up immediately. Just because you see 10% annual inflation, you're not going to see 10% price rises right now. But in 4 years' time, 100 grand won't see the same value as it is today. So how can a 100 grand house today still be 100 grand in 4 years' time when the value of that money has been eroded with inflation? So after a few years, it tends to pick up. The interesting thing about what I've just said is that in 1972, when the inflation spiked, the UK house prices doubled in 18 months. Between 1980 and 1985, UK house prices doubled, average UK house prices doubled in that 5-year period because of this inflation spike kind of issue. So it won't happen in time, but it will lag behind slightly. Now, I've done a couple of recessions, and I find that recessions are very exciting if you stick with these 7 rules. If you buy everything with margin, the exit is always for rental, you want to do margin of at least 30%, you aim to make everything cash flow positive, and when you refinance everything, you have little or no money invested in the deal, and you rinse and repeat that as many times as possible as you can do in the recession cycle. And that's why I don't want you to get bogged down with planning permission. Because planning permission, we've got 2-3 years of fun, right? You don't want to do a planning permission deal where you're waiting 3 years to get your money out. Do permitted development, you're in and out in 9-10 months, job done, rinse and repeat, have some fun. Because the deals you do in this next 4-5 years will make your property career. The deals that people did in the early 1990s, deals that people did between 2008 and 2013 made their property investing career. You will make a bigger return from these deals than you will do from deals that you do in a boom. So that's the 7 steps to success over the next 5 years. We do the most comprehensive 8-week course on the subject. On your back of your badge, there's a QR code that you can scan for the 8-week course. The 8-week course is really all the knowledge to do that 7 steps, because really, you don't want to get this wrong. The trouble with commercial property and recessions is there's plenty of margin for error. And margin for error is basically if you haven't got the education, you don't have all your ducks in a row, or you just do things a little bit blind. It's very, very difficult to recover from a duff commercial deal. So you need to learn it inside out to hit the ground running and make hay of the opportunity over the next few years. We also do a Mastermind program. I'm not going to waffle on about that now, but what we say to people is do the 8-week course. You'll have all the knowledge. And then if the approach and the methodology floats your boat, and the way we do things float your boat, then apply to join the Mastermind. We're taking on people for September, our September intake, and that is where we work with people more closely to help them implement the knowledge that they learn on the course. We also JV with people. We're doing a deal in Leicester at the moment where we're converting a former bank building into 3 shops and 8 apartments, and that's with 21. It's a JV between 21 of our Mastermind students, and it's kind of learn while doing as well. So that's really all I've got to say. This is an exciting time, folks. And I think it's about having the right strategy for the right time. This is really no different to the strategy that I did in 2008. Because I've been converting commercial to residential buildings since 2000. I did my first one in 2006, actually, a shop on the Holloway Road, converted into a flat under full planning permission, because PD didn't exist. So I did this strategy from 2008 to 2013, 2014. It was fantastic. Those 7 steps, absolutely fantastic. But all the commercial buildings we converted were under full planning permission, and it was a pain in the behind. You know, you guys have got it easy. To rinse and repeat what I did in between 2008 and 2013, you've got it far easier because you haven't got the hindrance of planning permission. Most of what I was doing back then is now permitted development, so it's about learning that inside out. And the other thing is funding options are far greater than they've ever been before. If you find a deal, you can find the money. I think Property Elevator proves that. If you've got a deal with 30% margin, and you're likable and it's a good, interesting opportunity, those sort of deals usually get funded. That's it for me. Was that okay? Does that give you a few ideas?
Would you like to explain why you've come here today to the Baker Street Property Meet?
Me and my JV, we watched a lot of YouTube videos for Ranjan, and he sort of inspired us to and opened our eyes up into the commercial world.
Okay.
So we're very much interested in exploring the whole concept of commercial property.
Yeah.
We're experienced in buy-to-let properties, residentials.
Yeah.
And we're just interested in meeting different people and developing some contacts as well. And we heard that it's such a large networking event, and we thought it's a great opportunity for us to come here and meet many different individuals, like-minded individuals.
I'm Lena Chapman. I have come here because it's a well-known event, and you get to meet, you network with 300 high-quality commercial developers, and actually I'm here because I did training with Ranjan, and also I get to meet you.
Oh, well, thank you very much. You're very kind. Yeah.
And then coming to a program like this, meeting people, meeting possible investors, that's why I came here to present our company.
High energy, and good contacts. I think contacts is the main thing I would want to go away with from here. Like some really good, that aren't time wasters. So you get a lot of time wasters in the industry, so I just want some that aren't wasting
some
my
quality
time.
people.
Yeah, that's it.
Well, I've started Ranjan's course, the commercial workshop, and I've seen a lot of the videos with you and him in, and it does seem very professional and based on data and knowledge and experience, and it seems like one of the more solid courses and experiences to go on.
High streets across the land are changing forever. Basically, there's an oversupply of retail premises. Shops are closing down, more are going to close down in the future. The government know this, and that's why they're introducing a light touch planning system which allows small developers to easily repurpose these buildings to residential use under a light touch planning regime called permitted development. Now, this is going to be the biggest revolution and the biggest change and the biggest opportunity for property investors that I've ever seen. And this is all coming into effect on 1st of August. So you need to know what's happening and what properties to look for to take advantage of these opportunities so that you can get in there and take that first mover advantage. I've got a 90-minute free masterclass to get you ready for August the 1st. Make sure you join me, click the link below. Whether you're a beginner or expert, we'll get you started.